So continuing to previous session on the types of business structures or business organizations, we were discussing the limited liability company. So we continue to that. So what we discussed was the limited liability company is a very recent corporate structure that has rapidly gained popularity due to its unique feature of providing limited individual liability type of corporate structure. So its distinguishing feature is that it combines a corporation's restricted personal liability with a partnership's tax advantage. So some of the benefits of this kind of company or this kind of business is that first of all, biggest advantage is that it has limited liability. That is, if the company goes into losses, the recovery will not be done from the owner's personal assets or personal property or personal wealth. That is the concept of limited liability, and that is the best part of this kind of business. So it is one of the most important advantage or benefit of this. So that means that members' assets are, they are typically insulated from any business debts and liabilities. The next advantage is that it is like LLCs, like partnership, they are considered pass-through businesses for tax reasons. And therefore, what happens that individual members, they share profits and losses, eliminating the double taxes. Because once if the LLCs are taxed and profits are distributed after charging those taxes, then this profit money distributed to all the members will not be doubly taxed as his individual income. They will be exempted from their personal incomes. After that, LLC, it is a combination of more people, that is more than two or more people. So here it provides lots of flexibility in management in terms of structure, because members have the option of managing the firm directly or appointing the managers, which allows for more flexibility in meeting the operational demands of the business. The operations are quite simple in comparison to big corporate houses because it requires lesser formalities to be completed. There is a less administrative work regarding the meetings, record keepings, and annual reporting, etc. Not only this, the flexibility is also in terms of ownership. Because here it is a flexible structure in terms of ownership, in the sense that members can be, they may be individuals, they may be already the members of other LLCs, they may be already running another business, or they are foreign entities. So there is lots of flexibility in ownership arrangements. It's not that the person is not attached to any other bodies. Next, profit. There is flexibility in profit distribution too, because the profits can be divided among themselves, allowing for different distributions based on maybe whatever criteria is established in the operating agreement. Here, because of the limited liability, personal assets of the members are they are insulated, or they are protected. It protects, safeguards the owners or the members from business creditors, reducing the personal risk in the time of financial difficulties or lawsuit. They are protected because of the limited liability concept. And therefore, we find that LLCs are more attractive to investors in comparison to sole proprietors or partnerships. The structure provides investors with reduced liabilities while keeping pass-through taxation, as well as flexibilities in so many terms. The other side of the coin of LLCs are that they have certain limitations or restrictions. That is, maybe to begin with, the first is that there is a limited lifespan, because in some jurisdictions, And LLC's lifespan may be restricted, and it may dissolve upon the death or departure of a member unless otherwise stipulated in the operating agreement. Secondly, there is a bit the formation process is a bit more complex in comparison to sole proprietor and partnership. Obviously, it is less, though it is less complicated than the corporates, but it is more complicated than the partnership and the sole proprietorship. Then coming to the capital raising, again in comparison to corporates, they have limited capital raising capacities. It can be more difficult for them because if you want to attract many investors and or issue the shares, then you cannot do this in limited liability companies. Then another point is that another maybe constraint is that there is lots of state regulation to the LLCs, and the requirement may differ from state to state. Compliance with state specific rules is required, which may result into maybe additional administrative tasks. So here, and the next point is that it is the members of the LLCs are often subject to self-employment tax on their share of profits, which can be larger than payroll taxes paid by the corporate workers. So in some cases, they go for double taxation, or self-employment tax is called self-employment tax. So here, these are some of the I should say drawbacks of LLCs, but they are not that strong that one is to shy away from forming LLC. We have one or two more because when the members are more than one, then there are chances of disputes also. Maybe disagreement among the members emerge, and mainly if the operating agreement is not clear, or there are differences over management decision or profits sharing. So with the flexibilities come other drawbacks. With lots of flexibilities, there is the structure is less formal, due to which they have some disadvantages, because maybe while flexibility is beneficial, it can also be detrimental if a more formal corporate structure is sought, particularly for enterprise that intend to go public or seek large outside investment. Next disadvantage or drawback is that the regulations that govern the LLCs, they different from state to state, as already said, and changes the ownership or other structural modification may necessitate further authorization. So when anybody is considering the LLC, individuals should carefully weigh all the benefits and drawbacks depending on their specific business objectives, the nature of their activities, the desire, and the desired management and ownership structure. You have to consider all this factor before making final decision, and you have to, there should be drafting of a comprehensive operating agreement, which is very important for handling any issues and guaranteeing the company's smooth operation. Consulting with some legal and financial professionals who can provide a specialized guidance based on some specific business requirements. Next, we have corporations, which is a huge business organization or a structure, and it requires lots of formalities to be completed before it starts its functioning. So it is a legally formed entity. It is subject to laws of the state in which it was to be incorporated, and the states in which the business is to be conducted, because it is possible that a corporate may get registered in one state and may operate its functions or productions and of goods and services in another state, wherever it is conducting its business. So it has emerged as the preferred business for many small firms. Corporations are companies that have been authorized to act as a single entity. When a company's owner incorporates their business, they essentially separate their personal liability from that of a company. So it is an artificial entity. It is established by filing articles of incorporation with the appropriate state authorities. This gives the corporation legal status and the right to conduct the business. The article of incorporation serves as a public record of certain aspect of corporate existence. So, adopting corporate bylaws or internal rules of operation, it is frequently the corporation's first action after being granted authority to conduct the business by the state. So the corporation bylaws details how they detail you about how the corporation operates and is to be managed. So the bylaws have to be drafted accordingly. Corporations are more popular when the scale has to be larger in comparison to sole proprietor or partnership or LLCs, and therefore it bears certain advantages. Some of the advantages are, first, to begin with, that the owners of the corporations have very limited liability. Limited liability again means they do, at the time of loss or some problem, they do not have to sacrifice their personal property or asset. They are protected. There is Yes, they have access to larger capital formation because they can raise capital by issuing the stocks or bonds, making them popular among the investors. This access to cash enables prospective expansion and growth because with more money they can expand and have a bigger scale of operations. Companies, since it is in this case, since they are distinct ownership with a perpetual existence, that is because the company is an artificial entity, therefore it has a perpetual existence. Corporation have eternal existence. They have eternal existence, which means that the company can continue to exist and operate despite ownership changes or stockholders' death. Because the owners may come and go, but the artificial person which a company is distinct from its owner, it continues. Therefore, we say that it has a perpetual existence. And therefore, the corporate sectors, the corporate structure, this corporate structure, it frequently projects a very professional and established image, which can help attract more customers, more clients, and maybe they can, have better efficient business partners also. Corporation, they can also provide numerous employees benefits such as stock options, retirement programs, health insurance to help recruit and retain better talents, because once such facilities are provided, more people are attracted to work in the corporate sector. Corporations can also use tax planning tactics, including deducting business expenses, providing tax advantaged employee benefits, and potentially benefiting from reduced corporate tax rates. Next advantage is that there is flexibility in transferability, because there is possibility of transferability of shares. Shares in a corporations are obviously transferable, allowing for a straightforward buying and selling of ownership interest and giving more liquidity to the shareholders, more flexibility also to the shareholders. And since there is a separation between ownership and management, they are two different, board of directors and officers are different group, and the shareholder and the owners, they are different. So establishing a clear line between those who own the organization and those who run it day-to-day activities is possible. And therefore, though the shareholders have the say, the voting right in the running of the organization, in the functioning of the organization, but at the same time, we have a specialized expertise among the people who are managing the corporates. So these are some of the benefits, and therefore we find that corporates usually function on a large scale. But then we must look at the other side also, that is the disadvantages or the restrictions that are there with the corporations. First is that forming a corporation actually entails more complicated legal and regulatory procedures other than any other kind of business organization or structure. Therefore, it is more complex, and it takes more time, more paperwork in forming. There is another disadvantage in terms of double taxation. We have seen that in partnership there is no double taxation. In LLC also there is no double taxation, but here the corporation, they face double taxation, which means that profits after distribution as dividend, they are also taxed at the corporate level before shareholders are taxed on dividend paid. So this can lead to increase overall tax liabilities on the corporation and the members, owners. Since it's a huge structure, so it has to follow rigorous procedures such as holding frequent meetings, keeping extensive records, and filing yearly reports. There's lots of things that has to be kept, and in order to keep things regulated, lots of formalities and record keeping has to be done. So it becomes more complex, and failure to do so many may result, so many paperwork, it might result into legal and financial ramifications also. Another point we can say here in relation to corporation, it is that the corporation, in order to meet the legal and regulatory standards, it has to bear heavy costs often. So corporation may need specialists because to complete all the to complete all the paperwork and to run the whole big structure, they need specialists, they need experts, maybe the services of the lawyers, services of the accountant to ensure the compliance with complex legislation, which leads to a costly affair because they have to pay them accordingly. This can be a drawback, inviting lots of expenditures on this head. Then another point we can discuss here is regarding the flexibility part. The corporations have limited flexibility because regarding decision making, corporations are less flexible in comparison to other structures, because here they require approval from the board of directors and the shareholders, and therefore everything has to be decided calling upon a meeting and taking consent from all the shareholders and the directors. So that restricts the flexibility of decision making, and maybe it involves more time span also. There is a potential for shareholders dispute too, though they are flexible, they are coming and going, but still differences of opinion among the shareholders or maybe conflict of interest may result into disagreement, disturbing the business's smooth operation. So there can be a disturbance. Another problem may be that corporations, they often face heightened scrutiny from regulators, shareholders and the general public. people have eye on the corporations. So in order to, the compliance with numerous regulations is very critical to avoiding legal problems, and therefore this becomes sometimes a problem, or maybe cumbersome in meeting the scrutinies that has to take place. There is another drawback is that there is lack of privacy. Corporations, particularly public ones, they must take financial and other details to the public. They have to be transparent. They have to publish their books of accounts, that is final accounts. They have to give details of all the heads in their final accounts, that is their balance sheet has to be made public. So this lack of privacy may be an issue for some business owners. So this was about the corporation. Now we come to S corporation. So let us see what this S corporation is. It is a type of corporation used for some specific tax advantage. It is an IRS construct. State corporate statute do not take into account S corporation status. Its objective is to allow small corporations to be taxed at the federal level in the same way as partnerships are, while simultaneously enjoying many of the benefits of the corporation. It is in many ways similar to limited liability company. The critical distinction is the firm's criteria to qualify as the S corporation under federal law. To qualify as an S corporation under the current IRS guidelines, a corporation must meet the following requirement. That is, first, the number of the shareholders must not exceed 75. Shareholders must be the citizen of that country. Only one class of stock is allowed. Shareholder must agree to the S corporation status. And the last point to be kept in mind is to be followed strictly is to get S corporation status, we have to submit it with the IRS. So the S corporations, the S corporation, they keep all the advantages and disadvantages of a typical corporation, except for S corporation shareholder, except for taxation. S corporations, the shareholders are taxed similarly to partners in a partnership firm. And S corporations, income, losses and deductions are passed to the individual shareholders. Hence, it is not subject to the double taxation. Furthermore, unlike normal businesses, its stockholders can deduct any corporate losses. So, this is what the concept of S corporation is. Its benefits, or maybe the advantages. The first point, it is common to the corporations that it has, the members have limited liability. Then there is an advantage of pass-through taxation. That is because they are considered pass-through entities for tax purpose, because profits and losses are distributed to shareholders, preventing double taxation at the corporate and individual levels. Then there is avoidance of self-employment tax here. Unlike sole proprietorship and partnership, S corporation shareholders may be allowed to defer from self-employment taxes on their portion of company's profit. There is a flexible income distribution, because its shareholders can receive income from salary and distributions, potentially saving money on payroll taxes, and therefore they can earn better than any other form of corporations. There is another advantage of this is that the S corporation, their shares are transferable, which makes it easier for shareholders to buy or sell their ownership interest than other corporations. There is a perpetual existence here as other corporations. Employees' benefits are also available here because it provides a variety of employee plans, employee perks, including health insurance, retirement program, and stock options, thereby attracting and retaining competent personnel. At the same time, the S corporation bears certain disadvantages also. That is, they have eligibility requirement for the members, for the owners. They must meet certain conditions, for example, including a maximum of 100 shareholders, all of whom must be citizen or resident of that country. The ownership structure is also limited because they cannot have more than one class of stock, which limits the flexibility in structuring the ownership interest and may complicate fundraising attempts. There is restriction on shareholders too. S corporations are not permitted to have specific categories of shareholders, such as other corporations or non-resident foreigners, which will limit the pool of possible investors. There's lots of formalities regarding the record keeping and other formalities like corporations, like C corporations, as we have discussed already. Lots of bureaucratic control, paperwork, meetings, and decision making. So it requires lots of formalities and record keeping also. After this, another drawback is that they are restricted at their ability to retain earnings. That is, excessive retained earnings might result in penalties or the loss of S corporation status. This has to be taken care of. Then disputes between the shareholders sometimes might emerge, disrupting the smooth operation of the business. Therefore, clear shareholders' agreements are very much necessary for managing potential conflicts and avoiding them. In fact, the paperwork, the agreement has to be thoroughly prepared and understood by all. And then we have the last drawback or constraint attached to this. It is the tax complexity. Because while S corporation provide pass-through taxation, the distribution of revenue and deduction can be complicated. Shareholders may need to manage complex tax rules, and therefore, this becomes a point of difficulty often. Another point is that to keep the tax status, the S corporation, they have to follow strict IRS regulations. Failure to comply with these standards may result in the loss of S corporation status. So, looking into the strength and the weaknesses of S corporation, still many people are attracted to go for this decision because maybe the corporation which require normal corporation, C corporation which we call, they require lots of formalities and paperwork before getting registered. But S corporation are comparatively on a smaller scale and comparatively more flexible, and therefore people opt for S corporations in order to run their business as one of the business structure. So we discussed this much in the session. The next session we will continue with the other part of the types of business structure. Thank you so much.